All right, welcome everybody and good morning on this June 19th, 2024. All right, so markets close half day today for the holiday, and they are open, I think, right now. We'll take a quick look at the markets and give you an overview of what's going on. They're kind of stagnant today, no surprise, being a short day. All right, let's jump right into the material here. I'm going to go full screen here and walk you through some administrational items. First thing is give us a like, give us a share. And if the audio or anything goes on the blink, let me know in the chat area as well as the video portion. I'm usually the last one to know if there's a problem, so that's very helpful. All right, in terms of risks, always know your risk when you're trading the financial markets. We deal in a realm of probabilities. Many trades do not work out, but the idea is when you have an edge in the market, more usually work out than they don't. And when they don't, we cut our losers really quickly. And so the edge is a combination of your win percentage and your payoff, which is your average wins versus your average losses. So I've written a couple books on that, and I'll share that in just a moment with you. But risk control really is everything in this business. We of course have entries and exits that are designed to give us a winning percentage. But again, if you don't have good risk control, it's hard to maintain that. So keep that in mind. Also, too, if we look at any stocks or anything today, run these by your financial advisor, simply because I don't know your personal situation. They do. So some things we talk about here may be suitable for you or may not be, depending on, things like your age and your net worth and all that kind of good stuff. All right. So and also to fund your trading account with money you can afford to risk. Don't overdo it, so to speak. All right. A couple books on money management that I think you'll find very helpful are the Money Management for Traders and a Trader's Money Management System. I'm going to put a link in the recording of this where you can actually access these books on our Amazon homepage. So definitely check those out. And we got pretty good prices on those. The new book, second edition, Art of Trading, has been completed. It's in the hands now of the publisher. And so that's due out later, I think, this year. Very excited about it. Around 500 pages. It depends on how they lay it out. Could be a little bit less, could be a little bit more, but it's going to be a big book, and it's a culmination of my over 30 years of trading the financial markets. So you're definitely going to want to pick that one up, probably on a pre-order situation, simply because they don't charge it until it's released, and also you get a better price. All right, so like I said, Wednesday, June 19th, we got June 10th. Rather today, the holiday, but we do have mortgage applications coming out in the housing market index, and these are all Eastern time, so they're out already. Jobless claims, housing start permits for tomorrow. Usually Thursday is the most busiest day. We also have a couple Fed speakers, bill announcements, Fed balance sheet, and Friday we have quadruple witching, then PMI, existing home sales, leading indicators, EIA natural gas report, and Baker Hughes. So markets will reopen tomorrow as normal. All right, when we look at charts, we're going to be looking at charts using our trading system called the ART system, along with the OWL, PTF, TLM, and ERI, with scanners and with risk control software. We try to emphasize, once again, different aspects of trading. So think of trading like a trading pie. You have to find the opportunities first. So therefore, that's where our scanners come in. Then once you find the opportunities, possible opportunities, when do you get in, when do you get out? The timing of the trade. That's that top row of the ART, OWL, PTF, TLM, and ERI indicators. And then at the bottom, of course, before we take the trade, we want to know how many shares or contracts, if you're trading futures, to buy or sell based on the risk you want to take. And that's where the risk control software and record-keeping software comes into effect. So we try to cover all those major slices of the pie, and therefore we call it the ultimate trading system. And once again, I'll put a link at the bottom of the recording here so you can check those out. All right, here's the daily chart. So we're skimming along this upper area here. And for those that are into Elliott Wave, this is a 4, and this is a wave 5 target zone. For those that are not into Elliott Wave, basically all you need to know on this chart is that there are 5 waves in any significant trend. At the end of the 5th wave, the trend is over. So as you can see, we're getting up to a zone here where this bull market trend is close to being over. And this wave 5 target zone is actually calculated on the 2009 low. Okay, so we go way back in this. So that's a big deal. That's a big target up there. Now, we haven't quite gone in it, but we've come darn close. And sometimes darn close is all that happens. And in this case here, if we don't hit the target zone 15% of the times, don't forget, we're in a realm of probabilities when in the market. So 15% of the time, we miss that target zone. 70% of the time, we get in it. So it's a pretty good bet to always assume we're going to get into that target zone. Now, how far into it depends on some calculations we do in the lower time frames. All right, so when we start to get in that, we'll be a little more precise of how far into it we're going to get. So that kind of thing. And the other thing too with this is that, you know, you also, if it ends here, you have a classic double top here, right? So we got to keep that in mind. But once again, I think probably anything in here is noise, and it could always rebound back to the upside. With that said, I've got two key support levels I'm keeping an eye on. Both are pretty far away. The first one is actually the minor support at 37,611.55. So, you know, we're teetering around what, 38,000 to 38.5. So, you know, we're about 1,500 or 1,000 points away from that roughly. So that's quite a distance here. But if we break that minor support, that's a big concern for me, because that really shouldn't happen if we're going to go back into that target zone. So that's something I'm concerned about. If we go below the major support here, then the chances of being in our major bear market are huge. Okay, and that's at 32,327. So think a bear market here, okay, and think down here, missed target zone. Let's say that. So that means if we come in here, break in here, we might get a rebound, but probably not get to the target zone and head on back down. So those are the levels to take with you, I think, as we go forward in this journey of the markets. And we never know what's going to end a bull trend. It could be news, it could be economic, it could be world events. But usually something comes along that changes the mood of the bull market to that of a bear market. And when we reach this wave 5 target zone on this daily chart, that actually will be a wave 3 top on a weekly chart. So then we go into a deep wave 4, which is going to last a couple years. So it's a big deal. So the next leg down, the next major bear market is not to be taken lightly, because you're probably going to see a sell-off anywhere from 38 to 61%. So that's quite a lot, okay? So take that into consideration. So you may want to meet with your financial advisor, go over some strategies you take in case that happens sooner rather than later. And there's a lot of things to take into account, like tax implications and so forth. But I'll leave that between you, your financial advisor, and your accountant. All right, on the daily chart, it looked like we had a little bit of a resistance level here, and then we should head back down. I still think we're popping around in that area. So I think we're still coming down. So I would anticipate, we'll take a look at that 60-minute chart today and see how it's looking. But I don't think that red PTF has gone away yet. So we'll keep an eye on that. So that's kind of important. All right, on the NASDAQ. Now, the NASDAQ's got quite a bit more room. It's not quite as tight as the Dow Jones. And this is kind of why I think basically we're not quite done with the bull market yet. So the target, short-term target is around 18,529 up to 20,573. And this is what you're looking at as a NASDAQ across different time frames here. 60 minutes over here, daily for the intermediate look, and then the weekly chart over here for the long term. The longer term anchoring points delivered is a little bit higher target on the NASDAQ between 19,387 to 25,129. So I kind of overlay this into here, and the 19,380s right around in here. So that's probably where we're going to end up, somewhere in this area once we have a top. So this is actually encouraging for those that are bullish on the market and still long. The NASDAQ represents a huge part of the market. You know, you've got your NVIDIAs in there, you got your Teslas and all those kind of stocks that really are fueling and carrying the market. So I don't believe the Dow is definitely not performing as well these days as the NASDAQ. But I think the NASDAQ still heading up will bring most all markets into that target zone, into their upper target zones. So that's bullish. And the S&P is not as close to the target zone as the Dow as well. And our S&P target is 56.55 to 6089. Longer term, it's a little bit longer. So we've got a little more move up, I think, probably through the rest of the summer. And like I said before, I don't think, the Fed obviously has not raised rates, and I didn't think they would. I called basically for a maximum of 2 rate cuts this year back in the beginning of the year. But I think right now we're probably looking at 1 before the election, and then we'll see. So I think they're going to try to keep these markets cranking along until at least after the election for some form of stability, okay? So I think that's kind of what we're looking at here. So, I'm bullish on the market for currently. We're in an uptrend. There's no denying that. We're having a little pullback in that uptrend, but it's not severe enough to say the trend up is over yet. So there you have that, okay? And if we keep going on, a little talk about the real estate market. All right, let me just see if there's any questions coming in. All right, Constance, how are you? Constance has got a bunch of stock picks up there for me. Constance, we do that on Stock Analysis Friday. So on Friday, we look up everybody's stock, and we're together for about an hour and 15 minutes on Friday. And that's here on YouTube as well, or Facebook or LinkedIn, wherever you're tuning in from. But that is reserved for looking up stock picks and for analyzing those stocks. So please come back on Friday, and I'll be happy to do that. I'll only be here for about a half an hour today. All right, we try to keep this brief yet concise, but pretty specific. Great. Okay, good. See you Friday. All right, so a little talk about the real estate market. All right, so as we're getting into June here, the May stats have come out, and basically the inventory grew 35% over the last year to a national average of 788,000 listings. So that's encouraging in terms of getting more supply on the market. There's still a lack of demand, however. Now, with that said, too, the Fed did not lower the rates, so they're keeping them flat for now. So that I think the real estate market was hoping they'd lower those, so interest rates would come down on the mortgages, but that has not happened. But interest rates have come down a teeny bit. But in any case, the more supply you get on the market, actually, the better the market is in terms for buyers to select. So usually prices start to come down a little bit. I don't think that's quite happened yet, but it is in some parts of the country. Don't forget, this is a national average. So if you go to a place like California, San Diego, or any places like that, yes, inventory is growing, but it really hasn't affected pricing yet, okay, over there. It hasn't grown enough. And I got another chart here that specifically talks about California as well, okay? So basically what this was very interesting in saying, and this came out recently too, is that the inventory needs to come up quite a bit more before we actually see any type of prices coming down in California, okay? So they're not quite up at that level where they're meaningful. So this in the title here, it says there's still an inventory shortage in California. Listings need to increase 20 or 30% more before prices drop meaningfully. So, and I think in the hot spots of the country, that's kind of where it is. Prices are still dramatically high, especially in California. Here's just an announcement once again from the Fed indicating 1 cut this year despite mild inflation. So And again, so far the Fed watch has got that cut coming statistically in terms of a percentage in September. All right, now mortgage applications drop again. This was at the end of May. All right, we're sitting at record lows in terms of mortgage demand. Actually, worse since 1995, and that's not good for the mortgage industry. And it also shows that there's not much transactions going on in the real estate industry. So even though you've got inventory increasing because you don't have more buyers in the market, you don't have the demand for mortgages. And so they're falling off. So prices are high, but transactions are low. That's kind of the story throughout the country, I think, right now. But not a good time to be a mortgage broker. I hope nobody out there is suffering during these times. But if you're a mortgage broker, that's going to be a tough business to be in right now. So definitely got to grit your teeth and work hard. All right, so 30-year fixed mortgages, and this was as of June 14th. So this is, 5 days old now. But the mortgage 30-year fixed was around 7%. The week before, it was 7.03. So like I said, it came down a tidbit. 15-year fixed is at 16.43. That came down from a week ago as well. The ARM is at 6.71. That's come down. And the 30-year fixed jumbo is at 7.17. That was up 0.02. So those are the rates that I like to share on that. Now, the Case-Shiller Index is something I always do like to share here before we move on and take a look at some of the current markets out there. So the Case-Shiller Index is basically the red line here. And this is the average home prices throughout the United States. Again, real estate's very local, so it depends on your area. But this is an average. And the line below it here is what they call the CPI, or Consumer Price Index, which kind of measures inflation. And I say kind of because it doesn't take into account, I don't think, energy and certain in the food sector as well. But as a gauge they use. And as you can see, this chart goes back 50 years, back into the 1970s. And real estate, represented by the Case-Shiller red line, has always been above the CPI, which makes real estate a good investment, right? So not only it gives you a place to live, but for many, many families out there starting out, it's a good thing to get involved in real estate. And if you get a mortgage, appropriate mortgage that you can afford, then of course you get to your tax benefits are writing that off. So there are many benefits of real estate, primarily being able to live there and at the same time have an investment and at the same time have a tax advantage. So real estate's been known to be good for that. The problem occurs with real estate in certain times is when you get prices exorbitantly higher than the CPI. So that causes the Case-Shiller to stretch away abnormally from the CPI. And we saw this during the financial crisis. I'll just put FC up here. And this was an area, of course, we all remember. What really happened to help cause this is they started back in the late 90s. They started securitizing the mortgage industry, which means that the mortgages could be sold on the secondary, basically, like the stock market, the exchanges. So that gave bankers an incentive to write as many mortgages as they could because they made money on that by going into the secondary market, and they package these things. Problem with that is what they did in order to do that is they lowered the standards to get a mortgage. And there were times back, and I'm sure many of you remember this, back near around 2000 and on, where basically if you could breathe, you could get a mortgage. Remember that? As long as the house had a value and you had a decent credit rating, they didn't even look at your income. They basically just gave you a mortgage. Well, that created this spike, all right, up here. Also, too, rates were low, all right, and the economy was humming along. So it was a perfect storm for an increase in real estate values. Well, then the recession hit, and we started getting into a problem where people couldn't afford these mortgages because a lot of them got secondary mortgages, and the mortgages didn't require an income check. they lost their job, and they were overextended. And so then you had a problem where houses were dropping fast. People were trying to get out. Banks were taking losses because of all the short selling going on in the housing industry, and the market corrected. Okay, so up it went, down it went. Then it got to a comfortable level, higher than here though, but comfortable. And the market recovered, interest rates went lower, and you had a situation there where it started to increase. Couple things to take note here. The low rates and improving economic situation caused real estate to continue up, still had the tax benefits. And then you had COVID. All right. Once COVID came, you had a lot of stimulus money. You had basically banks were allowing you to defer payments to the back of the mortgage. People were getting out of the cities, moving to the suburbs. So housing demand increased dramatically. And here it is going up like a shot for right now. And then you have more people living in the country now than ever before. So all that is fueling the real estate market. Now, what's interesting, I'm going to erase these lines, is that this bubble here, by the time it actually sold off, it was about 1.5 to 2 years where it remained at these upper levels, where it didn't go anywhere to the upside, and it didn't go down. So bubbles sometimes top out and don't reverse right away. They stay, bubbled in this area. Now, our current day situation here, all right, is worse than here in terms of the distance of the Case-Shiller red line away from the CPI, right? And notice the CPI is reflecting the increase of inflation here. So that's kind of interesting. All right, so you've got that huge distance. Now, in order for this to work its way down here, you're going to have a 40%, probably a 50% reduction in the Case-Shiller index, which means prices, for it to get back in line with the CPI. So that's concerning for the real estate market right there. Now, if you get into hyperinflation, well, the CPI could come way up here, right? And then housing would have to only go down a little. So it'll be interesting to see, because some people are predicting hyperinflation. I don't know. Okay, we'll have to see how that's going to work out. But for right now, something's got to give, that's for sure. And most likely it will be housing, because nobody can afford it. Okay. And if inflation goes up, housing is going to go up even more. So there comes a time and a point where, we've already reached a value in housing that, people can't afford it at these levels anyway. So pretty tough time, especially for first-time home buyers trying to get into that ultimate investment of a place to live and a hedge against inflation. So probably we'll get a bust in the real estate bubble at some point. Hard to know exactly when, but it could be like the stock market. It'll get to a certain level, and then the economy could change. There could be a world event problem, or something usually changes the mood, and down it will come. So just keep that in mind. Really tough to know the tops on these bubbles when they're going to reverse. But in terms of the graphs, it certainly is kind of shouting that it's overextended at this point. Little thing on Apex Trader funding I like to end with is basically for those of you that are active traders, this is a great thing to do, because they supply intraday data on the futures market for you while you learn to trade in a simulated account. So we've got a discount that we can provide you. So I put that up into the chat area, and you may want to check that out. All right, enough said on that. Let's go ahead and move quickly to some of the charts. I got a few minutes left here. I'm going to cover some of the major markets that I think are of interest to people here. And the first one is Bitcoin. Bitcoin's sliding right now, okay? Coming down again. We're in the 64,823 range. So I'm expecting this to level off somewhere in this target zone between 62,494 and where it is now. And then it should start to head back up. The bottom, I think, for this major pullback has already been put in here. So that's done, we hope and think. And we have a clear ABC corrective pattern. So 3, 4, and then we should start to move up into 5. So I'm thinking this is probably just a little bit of a profit-taking area in a trend that's still moving up. The target, I think, on Bitcoin is this wave 5 area here between roughly 89,792 to 110,000. When we're going to reach that, at this point here, I was hoping we would continue up a little higher, get above this high and be on our way. But this current sell-off is going to delay it for several months, I think. So you're probably not looking at that high being reached anytime before the winter, okay? And that's my best guess, so to speak. All right, silver. Silver is one we've been bullish on a lot. It is coming back. It reached its target. So if you were short-term trading, you would take some money off the table here. But long-term, you want to hold it, all right? It's still got some more upside potential. This correction is coming back into a pullback area, and I think it's almost over. So I think right now it looks pretty good in terms of breaking out. Let me just check here. Yeah, we got over this bearish price bar here. I'd say you could probably buy that now. Put your stop probably around 25, probably right around 25 point, I would say 49 would be a good place to put your stop in case it decides to take another quick dip down. But other than that, if you're still in it and you got your stop under this level here, I would just keep it there since you're profitable at this point probably. So I wouldn't worry about that. The primary to get on this is when it broke the pennant here. We had a pyramid, and that was right around the $21 mark. So you should be sitting pretty if you got in there. But again, we think silver is now going to continue to go up from here for the most part, especially if the market sells off. It may be a little wishy-washy until we get a top put in on the market. And I think gold, for the most part right now, is not much different. But gold reached the top pretty quickly recently, so I think we're kind of due for a move down. I would not be buying gold right now. Let's see. It's still coming down. I still think it's going back into maybe the upper 100s. So you'll have probably a better price at that point if you wait there. Okay, and that's that. All right, USO, which is the oil market. These are all ETFs, by the way, for the oil market. Okay, so the oil market here, we've got a pennant drawn here on the weekly chart, and we're hoping we get a break to the upside. My target on oil is around 100 to 124 before we should start to see a peak. And it looks like we may have a bottom once again in around 70. The major bottom is right around 57.95 or 4, somewhere around there. Okay, so basically this is a good one to be long in. If you're not long in it now, you might just want to wait till you break the pennant on the weekly chart. But I personally would just get in at this point and have your stop under 70, and I think you'll be fine. All right, so I think I kind of like that one. TLT, the bonds, is one more I'll take a look at for today. TLT is moving off its bottom, but I'm a little concerned because I'm not sure this is the bottom. I think what we're getting is a correction in an ongoing downtrend. So I'm looking for this to possibly get to 110 to 127, and we're at 94.5 right now. And then in that range, the target is 110 to 127. So what I'm expecting is we get up here and then come back down. The reason I kind of say that is this is a red PTF, 75% accuracy rate on this indicator. So it's indicating more lows coming, that's not a bottom. So unless that changes, this is the only trade I see possibly to that target zone. And it's not a bad trade because I think you can get in with a good risk to reward. But this is not a buy and hold yet. Okay, I don't think so. All right, so I'm trying to think of anything else. I think those are the major ones. The other one that people do like is GBTC, but we've looked at Bitcoin already, and this is the ETF for Bitcoin. And as you can see, that's pretty similar in terms, or it's almost exactly similar as the regular coin because it mimics the coin, okay? And so still coming down at this point. We'll see if this bottom holds here. So I'm expecting a turnaround probably in the next week. And then we'll take a look and see if that turnaround can actually take out the high here on both Bitcoin and GBTC, or if it's just going to be a brief move up and then another move down. If that's the case, we may then be moving towards the lower target zone. So we'll keep an eye on that. All right. So that is it for today. Hopefully, I covered the major topics that are good for you all. And we'll be back here next Wednesday, all right, with an update on everything. And don't forget, Friday is, of course, the Stock Analysis Friday, where we actually take a look at all your stocks. So join us there. And that's it. So have a great rest of the day. Markets are closing soon, so enjoy the holiday. And we'll see you back here next week. Thanks so much, everybody. Have a great week.